the Fed paused again. The second pause raised hopes that the hikes are behind us. In addition, it had positive GDP data for the third quarter, revised even more to an impressive 5.2%, both adding wins to the equity market, sales, and the bond market, as we will see. Major indices started November on a declining path, but closed the month at roaring returns, with the S&P 500 starting at 10 year-to-date, but closing at 20% year-to-date. The Dow moving from flat to 8%, and the Russell from -5 to 2.7% year-to-date. Meanwhile, inflation data showed that year-over-year PCE headline further dropping to 3% for the first time in 3 years, and PCE core also falling 20 basis points, while the M2 money supply is back to July 2021 levels. Mind you, the M2 is a measure used to estimate cash availability in the market, and noticing a decrease in it is a clear indication of disinflation. The combination of Fed pause and disinflation signs led to a rally in the bond market, with the 10-year Treasury yield at -11% month-to-date, the 30-year yield at -10%, as well as the money market yields, but those are at lower rate. To recap, the Fed opted to pause and monitor the consequences of its policy tightening unfold in the upcoming months, while the economy data showed impressive economic growth in the third quarter. Inflation cooling off, equity and bond markets both bouncing at the same time.